Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Happy Thanksgiving to you and your family. Got a short video today to give you a few facts for you to bring to your Thanksgiving gathering with family and friends. All right, three concepts. First, the market rally this year, which at the time of this recording, the S&P 500 is up around 14, 15%. It's broader than you think, right? Our economy is comprised of 11 sectors, ranges from energy to healthcare to technology. 11 out of 11 are positive this year. The headlines clearly are going to the technology stocks and anything related to artificial intelligence, but it's 11 out of 11 positive year to date. In terms of the market's performance, again, there's some headlines suggesting that the market is high or maybe we're in a bubble. S&P 500 year to date is up about 15%. If we take a look at the last 10 years and do the math to average out what is the market averaged each year over the last 10 years, it's approximately 15%. So this year, even though it might have some headlines suggesting things are overvalued or maybe in a bubble, the average return this year is quite consistent with what the average has been over the last decade. Theme number two, what about this bubble talk? Right? We're being asked about it every day. It's capturing headlines. What does it all mean? So I think for anyone over 40, when someone asks you about markets and bubbles, probably go back to the late 90s dot-com bubble and the aftermath that took place. So I thought it would be helpful to show you how is the market doing today compared to the late 90s, since that seems to be the obvious comparison. So what you have here on the left, 1996, 97, 98, and 99, the navy blue columns are the one-year return of the NASDAQ that year, and the baby blue columns, that's the cumulative return of the NASDAQ over that four-year period. So you'll see here by 1999, the NASDAQ cumulatively over the 4 years prior was up 287%. And that had a big exclamation mark in 1999 because the NASDAQ that year was up 86%. Let's fast forward to today. Here we are, 2025. It seems like we've had a little bit of a run up in things related to artificial intelligence and technology stocks. 2021, 2022, 23, 24. Here we are in 2025 with the NASDAQ up this year roughly 16%. Cumulatively, the NASDAQ this year and the previous four up 73%. So I don't know if we're in a bubble or how we define a bubble, but a 73% run up certainly feels a little bit different than a 287% run up. Let's go a little bit deeper into that. One way to evaluate how expensive or inexpensive a stock is through something that's called a PE ratio or a forward-looking PE ratio. We go back to the late 90s. Intel had a PE of 47, Microsoft 60, Oracle 120, and Cisco at the peak 130. Fast forward to today. Today, the S&P 500 has a PE ratio of 23, 24 in that ballpark. These four companies here, Google 26, NVIDIA 41, Apple 33, and Microsoft 31. Certainly a little bit more expensive than the average within the index. But again, if we're trying to make a comparison of a bubble from the late 90s to where we are today, the PE ratios look a lot different. Okay. And from a historical standpoint, let's take a look back in time and take a look at sort of where has the market been in the past, how has it been comprised, and what does it look like today, and how is it comprised? So let's go back 40 Thanksgivings ago. We'll go back to 1985, and if you were at your Thanksgiving meal in 1985 and the subject of the stock market came up, the 10 companies, the top 10 companies, the largest companies of the S&P that year were IBM, Exxon, General Electric, General Motors, AT&T, Shell Oil, Amoco, Royal Dutch, Kodak, and DuPont. And those 10 companies comprised 20% of the S&P 500. Today, at your Thanksgiving 2025 meal, three companies, Apple, NVIDIA, and Microsoft, three comprise 20% of the S&P 500. And then when we take a look at the next seven, from Amazon all the way up to JP Morgan, the next seven comprise another 20%. So 40 years ago, 10 companies comprised 20% of the market. Today, three companies represent the first 20% and seven companies represent the next 20%. So we definitely have larger companies and we also have more concentration of those companies in terms of their representation within the S&P 500. Now, markets have been around for a long time. There might be someone at your table this year who says you should put all your money in gold. Might be someone at your table who says put all your money in real estate, or maybe more inexperienced investors has put all their money in crypto. They're talking to you about that. But I think a slide like this is helpful because it takes a view over the last 100 years. And what this does over the last 100 years is this shows you by decade what have the returns been for stocks, cash, meaning money markets, bonds, real estate, and gold. And it's also helpful to keep in mind that an enemy of investors is trying to stay ahead of inflation and what inflation has delivered over time. So if we stick with the inflation column, inflation over the last 100 years has been over 3%. So you'd certainly hope to be invested in investments that can deliver at least 3% to keep you ahead of inflation. And the average return going back 100 years, gold, 6.5, real estate, nearly 5, bonds, closer to 4, cash or money markets, 3, and stocks here are 10. So obviously a diversified portfolio is always, the path that makes the most sense. Putting all the eggs into one particular basket usually does not make sense, but it's also helpful to keep in mind what these asset classes have delivered over time. So you can take this information, sort of use it as you feel appropriate at your Thanksgiving meal, but some nuggets here on how the markets are doing, some nuggets here about what's happening with bubble talk, and then some historical perspective on how markets behave over time. So happy Thanksgiving to you and your family. Our firm appreciates all of you and the trust that you place in us each and every day. And we'll try to be back in touch again before the end of the year. Thanks very much and happy Thanksgiving.